Good day and welcome to the presentation on employee benefits. In this presentation, we will do an example to illustrate the tax consequences as well as the disclosure of short-term employee benefits. Now, using the same information as from example 2 in part A of employee benefits, assume that the profit before tax of Light Limited after taking into account the short-term employee benefits amounted to R2,560,000, and you may assume that there are no temporary differences other than those that may arise from short-term employee benefits. The normal SA tax rate is 28%, and then the required states that firstly we need to calculate the current tax expense and deferred tax, but the deferred tax must be calculated using the balance sheet approach, and all of this for the year ended or ending 31 July 2019. The second part of the required is that we need to disclose the short-term employee benefits in the notes to the annual financial statements of Light Limited for the year ending 31 July 2019. So here the notes that you are required to prepare are specifically listed, being your profit before tax note and your income tax expense note. However, the tax reconciliation is not required. Your answer must comply to the requirements of the International Financial Reporting Standards, and comparative figures are not required. I'm not going to work through the calculations again relating to short-term employee benefits that comes from Part A, so we'll just include them here. To calculate the current tax expense, we need to start with the profit before tax. The information states that the profit before tax is stated after the short-term employee benefits have been accounted for. Therefore, the total amount of $7,317,334 has already been deducted from the profit to get to the profit before tax amount. Therefore, we will start with the accounting profit before tax of $2,560,000. Now we need to account for any temporary differences that may arise from our short-term employee benefits. So if we have a look at our short-term employee benefits, salaries are deducted for accounting purposes, but they are also deductible for tax purposes. A bonus accrual for the current year is deductible for accounting purposes, but not for tax purposes. Therefore, we have a temporary difference and we need to include it in our tax calc. The bonus accrual for the current year was deducted when calculating our accounting profit. Therefore, we need to add it back, as for tax purposes it is not deductible. Next, we have the prior year bonus accrual for accounting purposes. It is not deductible and was added back when calculating the accounting profit to account for the movement in the bonus accrual. For tax purposes, though, the accrual is deductible as it is now due and payable, and therefore the bonus accrual for the prior year must be deducted for tax. In short, our tax and accounting profits differ only in terms of the bonus accrual. So for tax, we're going to reverse what was done for accounting. When it comes to the bonus paid, it is deductible for accounting purposes as well as for tax purposes. Therefore, the temporary differences will amount to R37,334, which we will add to the accounting profit before tax, resulting in a total taxable income of $2,597,334. Tax at 28% on this will amount to $727,254. If we have a look at our deferred tax, we were told to use the balance sheet approach, which is comparing the balance sheet for accounting purposes being the carrying amount to the balance sheet for tax purposes being the tax base. In the prior year, in other words the year ending 31 July 2018, the bonus accrual amounted to R373,333 for accounting purposes. It is a liability and therefore we must indicate this, so I've included it in brackets. Next, the tax base is 0. Now remember that the tax base of a liability for tax purposes is the carrying amount less amounts that are deductible in future. So the bonus accrual is deductible in future, and therefore it will be the carrying amount of 373,333 minus the amount that's deductible in future, which is the full amount of 373,333 Rand. Therefore, the tax base is 0. This results in a temporary difference of 373,333 and a deferred tax of 104,533. Now, remember that the carrying amount is greater than the tax base, and we are dealing with a liability, and therefore it results in a deferred tax asset. Next, we have the current year end, which is 31 July 2019. The bonus accrual has a carrying amount of 410,667. The tax base is 0, as it is the carrying amount minus amounts deductible in future. This results in a deferred tax asset of 114,987 Rand. Now, again, remember we're dealing with a liability, and therefore the carrying amount is greater than the tax base, and it results in a deferred tax asset. So the movement in our deferred tax from 31 July 2018 to 31 July 2019 is 10,453 Rand, which is our current year's deferred tax balance of 114,987 minus our prior year, which is 104,533. Now, as you can see, if you look at the temporary difference line item, it is 37,334 Rand, which agrees to the amount in our current tax expense. The signs are just opposite. Now again, as in previous presentations, remember that for every debit there is a credit, and the deferred tax balance sheet approach represents a statement of financial position, whereas the current tax expense represents tax that is used in the statement of profit or loss. And if we have a look at our journals, when accounting for deferred tax, we will debit our deferred tax statement of financial position with 10,453 as our deferred tax asset has increased, and we will credit our deferred tax in the statement of profit or loss with 10,453 Rand. Right, so the second part of the required is that we need to disclose the short-term employee benefits in profit before tax and the income tax expense notes. Now, in profit before tax, under expenses, we need to disclose our employee benefits. Now, remember, employee benefits are made up of short-term employee benefits, post-employment benefits, termination benefits, as well as your long-term employee benefits. Now, in this case, we only had short-term employee benefits, and therefore we're only going to include our short-term employee benefits, but we will disclose the full amount of our short-term employee benefits in our profit before tax note, being 7,317,334, which we disclose next to short-term employee benefits. Next, we need to disclose the income tax expense note. Now, firstly, we have our current tax, which we calculated in the previous slide to be 727,254. And then we need to deduct our deferred tax of 10,453 Rand. This will give us a total tax expense of 716,801, and we can test this by taking our original profit before tax, multiply that by 28%, which gives us 716,801. Now, we can test it like this because there were no permanent differences. When there are permanent differences, you would need your tax reconciliation to do the test to see whether it works out. Now, the amount of 716,801 is the amount that will be reflecting on the statement of profit or loss under your tax expense. Therefore, the income tax expense note supports the statement of profit or loss. Now, the reason I am pointing this out is, as on the previous slide, I included the journal for explanatory purposes, and as you can see, we are crediting our deferred tax in this note, and that is consistent with the journal on the previous slide where we credited our deferred tax for profit or loss. That brings us to the end of the disclosure for our short-term employee benefits. Thank you for watching, and goodbye.